welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is William Mahan, who I'm going to call Bill, and he's an attorney here in San Jose. Bill does real estate law practice. He also does estate planning, and he does also some business law. So anyway, lately, Bill and I have both been involved in helping many people that are dealing with short sales and foreclosures, which are rampant here in California. And so, I've asked him to join me here today. His law office is now actually in downtown San Jose, in Park Center Plaza. Practicing law, I guess, 31 years now. Huh?
Yep.
And has a master's in taxation, letters of law from Golden Gate University, a JD from Santa Clara University. And anyway, like I said, Bill and I have been doing a lot of work in this particular area of short sales and foreclosures, so I invited him to come and go over some of the details with me today. So today we're going to talk mostly about mechanics, some of the legal considerations related to short sales and foreclosures, and we'll do a separate program for the tax considerations. And so I invite you to keep an eye, first of all, I hope you can watch the show when it's being broadcast, but we also, remember, we archive these at our website, which is financialinsiderweekly.com. And so just look under past episodes and you'll be able to find some of the programs I've done with Bill and with others related to short sales and foreclosures. Bill, thank you for joining me here today.
My pleasure, my pleasure.
Good. So as we get started again, I want to caution our viewers that this is an introduction. We're not going to cover all the details in less than a half an hour. We want you to get legal advice, but we just want to give some introductory information to help you along in this process, and again to make the foundation for a conversation with your own attorney and tax advisor.
Yeah, I would like to add to that this is just an overview. This is an area of law that changes all the time. It's new laws being passed in the state of California, new federal laws being passed, and the rules change quite a lot. There's a lot of information on the internet. A lot of it is good information. A lot of it is not good information. So there's a great deal of confusion. And so this is just to kind of give people a direction. They really do need to get specific advice, because each case, the facts make a tremendous amount of difference. Just small changes in facts can result in a completely different outcome to their case. So everybody's case is individual and needs to be looked at individually.
Good, thank you for that, Bill. And there is one other thing. So we do have people, this is posted on YouTube, so we have people that see this program that are living in all over the place, all over the United States, even some people outside the United States. And so we just also want you to be aware that the laws are different from state to state. California has laws that may differ from those in your state, and some of the details of how these rules work, they're quite different. So again, you need to get your own advisor from your own area. Bill, let's get started. We're going to finish with the introduction here. So first of all, what happens in a loan modification?
A loan modification is when borrowers, home buyers, go out and they get a mortgage, and either it has a high interest rate or the value of the property has gone down since they borrowed the money to buy it, so the value of the property has declined below the value of the mortgage, or the amount of the mortgage. And so a modification is a way of going back to the lender and saying that you want to change the terms of the loan. You want to change the length of the loan, or the interest rate of the loan, or even the principal amount of the loan, in order to get the payment different and to make it more in line with what the market indicates it should be. So that's the process. You would go back to a lender and request a modification of the loan. There have been a lot of laws passed and different programs started to try to encourage modifications, to encourage lenders to modify loans with the borrowers. None of it has worked very well.
The lenders don't seem to be paying attention.
Well, there's lots of reasons
Yeah.
for that. I mean, there are federal programs. One's called HAMP, the Home Affordable Mortgage Program. That's a modification program. Another one that's a little more recent called HARP, which is a Home Affordable Refinancing Program, which is not exactly a modification, more of a refinancing kind of a program. And different individual borrowers qualify, but it's very difficult for them to even find out if they do qualify. You ask your lender, and you're probably not going to get an answer. And there's lots of reasons for that. There's not a lot of incentive for the lenders, I think, to actually enter into modifications. They're not highly inclined to do so. And the laws that have been passed really haven't put any teeth into their declining to do that or refusing to do that. Some of the laws require them to discuss different options with borrowers and what their modification options might be. And if they don't do that, then there aren't really any consequences. So, for example, here in California, there's been a law pending in the legislature most of this year, maybe all of this year, that would put some teeth into the modification programs and require that lenders actually attempt to make a modification or at least give the borrowers the information. And if they don't, then the borrowers would have a private attorney general type of power where they could actually bring some action against the lenders and perhaps even get some damages. And that's been stuck in the banking committee in the legislature because they just don't get it through there, probably for the reasons being that the financial institutions don't really want that to happen.
Yeah.
So it's difficult for people to get modifications, but the process is still there, and some people qualify for it, and there are some modifications that get done. So it's certainly still worth looking into.
Okay. What is a foreclosure and what is a trustee sale?
There's different ways that property is taken if a person defaults on the mortgage, and different states again have different rules. Some states require judicial foreclosure, which is a process whereby the lender goes to court and forecloses on the property through court proceedings. That's called judicial foreclosure. In California, we have a trustee sale procedure where when people buy property, they finance it and there's a deed of trust that's recorded against the property. And the deed of trust names a trustee and the beneficiary of the mortgage and the person who owes the mortgage. And if the person defaults on their payment or gets behind on their payment, then the trustee has the power to sell the property. It's a quicker way of getting the property back to the lender, and it's been the procedure here in California for many, many years. The difference is, one of the main differences is if a trustee sale procedure is used we're talking here primarily single-family properties or 4 or fewer units in a property. If that happens, if the trustee's procedure is followed, then the lender cannot pursue any deficiency against the borrower. If they do the judicial foreclosure proceeding going through court, then after that, if there's still a deficiency, they have the ability to sue the borrower for the deficiency amount. So there's an advantage to the lenders to doing judicial foreclosure, but it takes much longer, and the borrowers can cure things and get back into the property in different ways. So the lenders just tend not to do that in California. It's almost never done for single-family properties, residential properties. So you can pretty much assume it's going to be a trustee sale in California, and once that procedure is initiated, then there's not going to be a deficiency against the borrower for the mortgage that is sold through the trustee sale.
So, and usually we're talking about the first mortgage in that case.
It doesn't have to be the first mortgage that forecloses, but it almost always is.
Yeah.
But the important thing to understand there is if there are other mortgages, like home equity line of credit or seconds or thirds or whatever, if the first exercises the power of a trustee sale, then the other mortgages become what are called sold out minor or junior mortgages.
Yes.
And then those lenders still have the right to sue the borrower under the terms of the promissory note. So those lenders could still pursue a deficiency against the borrower.
And this is in the trustee sale. We're going to talk about short sale in a little bit. All right, well, what about the deed in lieu of foreclosure? What's that, and is it a better alternative than a foreclosure or a trustee sale?
Deed in lieu of foreclosure is just another procedure where you go to the lender if you're behind on your property payments or if the value's dropped and it's not economic to continue to make the payment. you offer to the lender a deed to take the title to the property back, and it's in lieu of foreclosure because you don't go through the foreclosure process. It can be better if you can arrange it. It can be better than some of these other things because it's quick. There still are some problems with potential deficiencies. You'd have to work that out with the lender as well. But lenders have not been too willing to do that either. It's just a procedure, again, that is less likely for them to agree to than some of these others. Although lately, with some of the other changes in the laws, we'll talk about short sales here pretty soon, but some of the changes in those laws, I've heard of lenders now making overtures to the borrowers about doing a deed in lieu of foreclosure instead of a short sale or instead of a foreclosure. So some lenders, I think, have sort of turned the corner on that a little bit and are pursuing the deed in lieu of foreclosure a little more so than they were before. It varies from lender to lender and state to state and situation to situation, but I think that if there's a trend out there, it might be a little bit more toward that again.
Okay. So what happens if you walk away from a home that has a mortgage?
Well, walking away, I think people think in terms of just leaving the key in the door, leaving the house, taking your stuff.
Yeah.
It basically results in probably a trustee sale of the property eventually. But it can have some negative effect, I think, in lots of different ways. I think in terms of perhaps even your credit situation, because you abandon the property and you're going to get when you leave property, we're going to talk in another program about the tax consequences, but you get a 1099 when you leave, and one of the 1099s is a 1099A, which is when you abandon property. And so these all kind of have sometimes slightly different consequences. So, I don't think it changes the process so much as it does. I guess there's a possibility if you had a non-recourse mortgage, which we're going to talk about in a minute, and you walked away, you left the property, there might be a possibility, since you don't live in the property when it's foreclosed, that could create a problem with your non-recourse status with that property.
Okay.
Possibility.
All right, so now we're getting to the good one. So just a few years ago, I'd never heard of a short sale as it related to real estate. I don't know if you had very much either, but anyway, I always thought a short sale had to do, with selling a stock that you didn't have.
Selling short, selling short.
And but now it's become a widespread term related to real estate. And so maybe you can explain to us, what is a short sale of real estate, and is it a better alternative than a foreclosure?